In 1940, the Bank of England quietly transferred more than $1.7 billion worth of gold to accounts controlled by Nazi Germany. 2 years later, nearly 80% of the world's monetary gold was sitting inside the vaults of the United States, and almost no one noticed. It wasn't theft, it wasn't war loot. On paper, it was legal. But behind the polished walls of central banks and diplomatic offices, something much larger was unfolding. A silent agreement engineered under crisis that would shift the center of global finance for the next 80 years. Before the first bombs fell on London, European treasuries were already emptying their reserves. Gold bars vanished by the ton, packed onto ships bound for New York, Montreal, and Cape Town. Not because of panic, but because of calculation. Publicly, these were acts of protection, to keep gold safe from invasion. But protection from whom? Some shipments were escorted by British warships. Others, in a deeper twist, were facilitated by American financial intermediaries, even as the U.S. claimed neutrality. The Atlantic was a battlefield, yet tons of gold slipped across it almost without trace. Behind these movements stood central banks, independent in theory, in practice aligned with survival. The Bank of France, the Dutch central bank, even the Swiss, who declared strict neutrality, helped route gold, some from the Reichsbank itself. The volumes were staggering. Between 1939 and 1945, the global gold map was redrawn. Europe sent its wealth westward. The U.S. received it and quietly rewrote the rules of money. By war's end, the dollar wasn't just a currency, it was a promise, backed not by gold, but by the gold everyone else had surrendered. And here's the paradox. The war didn't just destroy empires, it consolidated the financial core of the modern world under the guise of security. What looked like rescue was, in fact, a transfer of power. To understand how nearly all the world's gold ended up in American hands, we need to go back to a moment when global finance was already broken, before the war even began. The year is 1931. Britain, under pressure from a collapsing empire and growing trade deficits, abandons the gold standard. Just 2 years later, in 1933, the United States follows suit domestically, decoupling the dollar from gold in everyday circulation. But internationally, the illusion remained. Currencies were still measured by their supposed gold convertibility. This illusion was fragile, and everyone knew it. By the late 1930s, the global monetary system was no longer about metal, it was about trust, and trust was running out. Europe was exhausted. Still reeling from the Great Depression, most central banks were caught between two impossible goals: maintaining the gold standard to keep international credibility and printing money to pay for internal survival. They couldn't do both. Germany had already defaulted on reparations. France was draining its reserves. Even the famously neutral Swiss were facing pressure. Their banks held vast amounts of foreign gold, some from private clients, some from states, and they had to pretend neutrality while trading with everyone. Meanwhile, the United States had something no one else did: a surplus. Between 1934 and 1939, the U.S. gold stock more than doubled, from roughly 8,000 to over 17,000 metric tons. That wasn't by accident. The Gold Reserve Act of 1934 had fixed the official price of gold at $35 an ounce, making it profitable for foreign central banks to send gold to the U.S. in exchange for dollars. Quietly, steadily, Fort Knox filled up. The mechanism was clean. A European country, say Belgium, would send physical gold to the New York Federal Reserve. In return, it would receive dollar credits, which could then be used to purchase American goods, settle debts, or simply sit safe in the world's most stable currency. But the political context was far from stable. In 1938, Hitler annexes Austria. In 1939, he invades Poland. War has begun. But even before the fighting spreads, the financial reaction is already underway. As German troops moved, so did gold. Governments that expected to be invaded, or simply doubted their own survival, began evacuating their reserves. Central banks became emergency lifeboats. Gold was their last anchor to sovereignty. And here the U.S. position becomes extraordinary. Although officially neutral until 1941, it acted as the de facto banker of the free world. European governments in exile stored their reserves in Manhattan. Some fled with nothing but their gold accounts intact. Others lost even that. Take the Netherlands. In May 1940, just before the German invasion, the Dutch managed to ship over 120 metric tons of gold to the US. The rest, nearly 40 tons, was captured by the Nazis. The line between survival and confiscation had become razor thin. Even the British Empire, still powerful on the surface, was financially vulnerable. To fund its war effort, Britain began selling its overseas assets, railways, shipping companies, entire colonial interests, in exchange for American support. But gold was always the foundation. Without it, the empire couldn't borrow. And without borrowing, it couldn't fight. The most significant transfer came in 1940, Operation Fish. A secret naval convoy carried billions in gold and securities from London to Canada, the largest movement of physical wealth in history at the time. It was a desperate attempt to keep the imperial economy liquid while under siege. But this also revealed something deeper. Gold was no longer just a store of value. It had become a weapon, a lever, a signal of who controlled the future. And in this new world order, power belonged to those who held not just the guns, but the vaults. By late 1940, the gold standard had collapsed in practice, but no one dared say it out loud. Currency still pretended to be backed by gold. Official statements repeated the promise of convertibility. But behind closed doors, central bankers knew the truth. There was no longer enough gold to cover the promises. This wasn't just a mismatch of numbers, it was a structural rupture, like a dam built for peacetime, cracking under the pressure of war. Let's follow the flow. Before World War II, the global economy operated, at least theoretically, on a gold exchange standard. Each major currency was backed by a reserve of gold or US dollars, which themselves were redeemable in gold. This created a triangle of trust between gold, the dollar, and every other currency. But war reprogrammed everything. Governments had to spend, massively. They printed money, borrowed beyond their means, and abandoned any real discipline. And gold, the ancient arbiter of restraint, became politically inconvenient. Take Britain. By 1941, the British government was nearly bankrupt. Despite receiving gold inflows from the colonies, it was hemorrhaging reserves to pay for U.S. weapons and food. The empire was being bled, financially, before it ever lost a single colony. In desperation, the British turned to their last lever, gold transfers in exchange for American credit. This was the origin of the Lend-Lease Act, a policy presented as generosity, but in reality, a calculated deal. The U.S. would provide Britain with military supplies. In return, Britain handed over gold, assets, and long-term economic influence. In just 24 months, over $1.3 billion in British gold reserves flowed into American hands. But Britain was not alone. From Poland to Belgium, from Norway to Greece, occupied or threatened nations shipped out their reserves, hoping to return one day. Some never did. A few transferred everything to New York or Ottawa. Others saw their shipments intercepted or stolen. The stakes were existential. With no gold, there could be no post-war recovery, no currency stability, no credibility. And in this storm, one player remained both neutral and open for business: the United States. Between 1939 and 1945, U.S. gold reserves soared from roughly 17,000 metric tons to over 20,000, more than triple the holdings of the rest of the world combined. This was not an accident. It was a funnel, a gravitational pull. The mechanics were elegant. Central banks, fleeing from war, deposited their gold in the Federal Reserve Bank of New York. In return, they received dollar-denominated credits. These could be used immediately, without repatriating the metal. The vault stayed shut, but the power moved. Some countries never requested their gold back. Others, after the war, found that political leverage had replaced convertibility. Access to their own reserves could be delayed or denied for strategic reasons. In effect, the U.S. had created a one-way valve. Gold flowed in, but not out. Here's where the system broke, quietly, invisibly. The world believed it was still operating on gold. In reality, gold had become hostage to political survival. Nations held gold abroad as insurance, but this insurance now lived in someone else's vault. And what does that mean? It means sovereignty was relocated, not symbolically, but physically, in bars, in tons, in numbered pallets stacked under Manhattan. This was the moment when trust inverted. Gold no longer backed the dollar. The dollar began backing gold. And after 1944, with the signing of the Bretton Woods Agreement, this inversion became institutional. Only one currency remained fully convertible into gold, the US dollar, but only for central banks and only at a fixed rate. That fixed point, $35 an ounce. On the surface, it looked like order. Underneath, it was debt, a growing imbalance hidden behind a stable facade. Because by tying global currencies to the dollar and tying the dollar to gold, the world created a system where only one player held the key to redemption. That key was in Washington. And here's the real twist. As more nations relied on dollars, the US could print more without immediately losing gold. Trust kept the system afloat. But it was a trust built on silence, the silence that no one dared break, that the vaults were no longer full enough to honor the promise. The system functioned until it didn't. Let's take it apart. After 1944, the Bretton Woods Agreement formalized a new global monetary structure. It looked stable, logical, even elegant. Currencies would no longer be directly convertible into gold. Instead, they would be pegged to the US dollar. And the dollar, the only currency still redeemable for gold, would act as the anchor for the entire system. That was the architecture. In practice, it created a funnel. Imagine it like this. Each country held reserves, not in gold, but in dollars. Those dollars were claims, promises that, if necessary, could be converted back into gold at the fixed rate of $35 an ounce. But only if the holder was a central bank, and only if they asked nicely. This allowed the US to issue dollars globally without immediately parting with any metal. As long as no one demanded gold in return, the system remained in equilibrium. But that equilibrium was artificial. It relied on two hidden assumptions: that the US would not print more dollars than it had gold to cover, and that other countries would not call in the promise. Both assumptions broke down, slowly, then all at once. From 1945 to the mid-1950s, the system seemed to work. War-torn Europe needed dollars to rebuild. Japan needed capital. The US exported both money and goods, running persistent trade surpluses. Dollars went out, gold stayed in. Trust held. But by the 1960s, the balance reversed. The US economy began running twin deficits, budgetary and trade. It was spending more than it earned and exporting more dollars than goods. The Vietnam War accelerated the trend. So did expansive domestic programs. Yet the gold price remained fixed. This created an unsustainable pressure. More dollars were circulating globally, but the gold behind them remained finite. Foreign central banks began to calculate how many dollars were out there and how much gold was left. By 1965, the numbers no longer matched. The US held roughly 14,000 metric tons of gold, but international dollar claims were rapidly approaching and then exceeding the value of those reserves. In other words, there were more paper promises than physical reality. This is the mechanism of a silent run, not a public panic, but a diplomatic drift. France, under President Charles de Gaulle, led the charge. In 1965, de Gaulle announced that France would begin converting its dollar reserves into gold, shipping the metal back across the Atlantic. Other nations quietly followed. The US responded by forming the London Gold Pool, a secret agreement among 8 central banks to artificially suppress the market price of gold by coordinated sales. The goal? Maintain the illusion of gold's fixed value and preserve the system. But illusions are expensive. Between 1961 and 1968, the pool sold over 3,000 tons of gold just to keep the market quiet. The deeper problem remained untouched. The dollar was no longer a representation of gold. It was becoming a substitute. Gold had turned into theater, a fixed price, controlled supply, central bank choreography. But behind the curtain, the disconnect grew. By 1968, the pressure exploded. A speculative surge forced the collapse of the gold pool. The two-tier system emerged, one price for official gold, another for the free market. The system was no longer unified. It was fractured, legally and economically. And yet, the dollar survived. Why? Because trust, once broken with gold, was redirected into something else: U.S. military power, political dominance, and the deep liquidity of American markets. The promise had shifted from metal to might, and from then on, gold was no longer money, it was memory. When a financial system breaks quietly, the consequences don't arrive with explosions, they arrive with signatures. In August 1971, one signature ended it all. President Richard Nixon stood before the cameras and declared that the United States would, temporarily, suspend the convertibility of the dollar into gold. There was no warning, no consultation with allies, just a simple decree. The promise is over. But this wasn't a beginning. It was the last move in a long sequence of denials. For years, the U.S. had insisted that the dollar remained as good as gold. Now, it was only as good as faith allowed. The Bretton Woods system, designed to prevent the chaos of competitive devaluations and monetary collapse, was over. The irony? It collapsed not from outside pressure, but from internal contradiction. Here are the facts. At the system's peak, the United States owed the world over $60 billion in dollar liabilities, but it held only $10 billion in gold. That ratio, 6-to-1, was unsustainable. Central banks began lining up to redeem their claims. The gold window had become a drain. France sent a battleship to collect its gold. Switzerland demanded physical transfer. Even Britain, America's closest ally, requested $3 billion in gold to stabilize its own reserves. The U.S. faced a choice: give up the gold or give up the system. It chose the latter. Once the convertibility link was severed, currencies floated. Gold's official price vanished. The dollar, no longer tied to metal, became a pure fiat currency, valuable only because the world still needed it. This created a chain reaction. Oil, which had been priced in dollars under the assumption of stability, became volatile. OPEC responded by quadrupling prices in 1973. Inflation surged worldwide. Western economies spiraled into stagflation, high prices with no growth. Meanwhile, gold exploded. Freed from its artificial ceiling, the market price of gold rose from $35 an ounce in 1971 to over $800 by 1980. That's not appreciation, that's a revaluation, a delayed recognition of monetary distortion. But here's the deeper impact. The loss of gold convertibility didn't just change policy, it rewired the global economy. Without a gold anchor, central banks could expand money supply at will. Debt replaced discipline. The invisible battery of the financial system, trust, now had no physical grounding, and trust is easier to inflate than gold. By 1985, the total global money supply had more than tripled. Governments could finance deficits without immediate constraint. Credit became abundant, but so did instability. Currencies became tools of policy, not stores of value. And the dollar? It remained dominant. Not because it was backed by gold, but because it was backed by history, inertia, and the absence of alternatives. But this came at a cost. Nations that had handed over their gold during the war, willingly or under duress, were now locked into a system controlled by the issuer of the very currency that had replaced it. The vaults were full, but the metal no longer mattered. And yet, those same central banks never sold all their gold. Why? Because somewhere, deep in the logic of money, gold remains the fallback, the asset of last resort. Not because it earns interest, but because it doesn't need to. It just waits. Today, the vaults are still there. So is the gold. But it no longer speaks. Not because it lost its value, but because it lost its voice in policy. The language of modern finance has moved on, from ounces and reserves to yields, spreads, and digital liquidity. But the architecture? It's the same structure with different wallpaper. Then it was gold-backed convertibility. Today, it's trust-backed credit. In 1944, the dollar was tied to gold. In 2025, the dollar is tied to confidence. And yet, the mechanics remain disturbingly familiar. Let's follow the pattern. After the collapse of Bretton Woods, the dollar could float, but it needed an anchor, something deeper than metal. It found it in oil. By the mid-1970s, the U.S. negotiated a silent pact with OPEC. Oil would be priced exclusively in dollars. In exchange, the U.S. would offer military protection, arms deals, and financial access. This became the petrodollar system, a new form of global demand for the dollar, backed not by gold, but by the world's dependence on energy. It worked, for a while. The world needed oil. Oil needed dollars, and the dollar needed a reason to stay central. This loop replaced the gold standard with a geopolitical one. But again, the illusion had a cost. To maintain this dominance, the U.S. had to export dollars continuously. That meant running trade deficits, buying more than it sold, financing consumption with debt. And just like in the 1960s, the imbalance grew quietly. By the 2000s, dollar reserves around the world were ballooning. China alone accumulated over $3 trillion in U.S. assets. Countries were no longer converting dollars to gold, but to treasuries. What does that mean? It means the world was lending its savings back to the U.S. in exchange for the privilege of staying in the system. A round trip of capital, backed by nothing but stability, or the appearance of it. This isn't ancient history. It's the scaffolding of now. Then it was called gold drain. Today, de-dollarization. Across the globe, countries are diversifying. China buys oil in yuan. Russia settles trade in rubles. The BRICS nations talk of a new reserve currency. Central banks, from Turkey to India, are buying gold again. Quietly, steadily, like it's 1938. And underneath the surface, one number keeps rising: global debt. Over $300 trillion today, more than triple global GDP. In other words, the world owes itself more than it can ever repay. The promises are stacked, and once again, the backing is missing. No gold, no convertibility, just liquidity. Then it was central banks exchanging vault keys. Today, it's quantitative easing and emergency lending windows. Different tools, same logic. Because when trust fails, the only response the system has left is to print. We saw this in 2008 when the financial system froze and central banks expanded their balance sheets by trillions. We saw it again in 2020 when a virus halted the world and suddenly money became digital, instant, and infinite. Liquidity became policy. Scarcity became optional. But every promise made without backing becomes a question of time. That's why gold, silent as it is, never leaves the conversation. It doesn't respond to politics, interest rates, or algorithms. It just is. And perhaps that's what makes it dangerous, because in a system built on confidence, anything that reminds us of limits becomes a threat. It began as a rescue, a continent at war, vaults emptied, ships loaded, reserves transferred, not for profit, but for survival. Gold crossed oceans, but sovereignty crossed with it. By the end of the war, 80% of the world's gold was in American hands, quietly, legally, permanently. No conquest, just custody. And with that, the rules changed. First, gold backed the dollar. Then the dollar replaced gold. Then trust replaced both. Today, we live in the echo of that pivot, a system built on promises, backed by memory, operating on momentum. But memory fades, and momentum eventually shifts. Because history doesn't repeat. It just waits to be believed again.